So even though Fed Chair Powell said it's going to take longer, markets ripped higher. For a look at why, we've got Carl Tannenbaum, Executive VP, Chief Economist at Northern Trust and former Senior VP at the Chicago Fed, and Garrett Melson, Portfolio Strategist at Natixis Investment Managers. Thank you, gentlemen, so much for joining me. Carl, I want to start with you. In many ways, the Fed has kind of acknowledged what the data has been signaling, that inflation is proving to be tougher to get back in the bottle this year.
Absolutely. So the key words in Chair Powell's delivery were confidence and sustained. Confidence refers to the Fed's knowledge or anticipation that inflation will eventually get down to 2%. He got a question as to whether they would feel more comfortable if inflation got close, and he kind of threw cold water on comfort at a higher level. Because the inflation news in the United States so far this year represents what I would call a mini head fake, not certainly what we had many years ago, which caused the Fed to look silly for having started to ease too soon. It is going to take a number of months before that confidence gets back because it has to be seen as sustainable. If you think about the timeline, it is going to take several months of much better inflation figures to restore that confidence, which is why both the markets and frankly in our own forecasting that the first ease from the Fed is unlikely to occur before late in the year.
And with that acknowledgement, Garrett, equity markets ripped higher. What was it? What were the doves taking comfort in?
Yeah, I think one thing to keep in mind any Fed day is that a lot of the reaction in equity markets is going to be a direct result of positioning and sentiment coming into the meeting. And so when you kind of take the pulse of what the marketplace entering the meeting was, I think there was a lot of fear that some of the moves and some of the data so far this year that Carl was alluding to would maybe shift that reaction function for the Fed and move them from that easing bias to something that might be looking a little bit more like a tightening bias. And I think the comments you've heard from Powell very, very clearly and directly stating that the next move is still likely to be a cut here. And so that, I think, is ultimately the key. There's obviously been a lot of focus on just how many cuts are priced in for this year. When does that ultimately begin? And yet, as you went through this year, you priced out, 5, 6, 7 cuts, almost down to no cuts for the full year. And I think that tells you what really matters at the end of the day. It's not how many cuts we get. It's ultimately about whether or not the next move is a hike or a cut. Powell is very clear in terms of how they're still thinking about that. And the reaction function, I think, is turning out to be very different from what the market's reaction function is. Markets are far more hypersensitive to the data than the Fed is.
Well, let's talk about that, Carl. The distance between not getting a hike and needing just needing one, right? We've sort of tentatively priced in maybe one rate cut, but, is it a very far distance between needing one rate cut versus maybe we need another hike?
No, it's not. And as Garrett pointed out, coming into the year, the market was expecting 6 or 7 cuts this year, and now we're down to 1, maybe 2. So revising expectations further to include the possibility of a hike doesn't go that far. But I think what the chairman is referring to when he said that he is currently comfortable with the stance of policy refers to the fact that it's taken a while for the impact of higher interest rates to affect the American economy. A lot of homeowners here have locked in mortgages for long periods of time, so they haven't been exposed to higher home loan rates. Consumer borrowing only recently got back to where it was prior to the pandemic, so the interest costs associated with that is only now being felt by the fraction of the population that borrows. Corporations were able to lock in long-term debt at low rates under a Fed guarantee in 2020. Most of those financings won't come due until next year. But month by month, little by little, it will have more of an impact. There are signs of fatigue. We saw earlier today with some job news that we got from the United States. And so while it's taking longer, I still think the Fed thinks that the inflation picture is pointing in the right direction.
Carl, multiple times he was asked about monetary policy, where it is right now and whether or not it is restrictive enough because the inflation, in some measures has actually started to go up. Reiterating, Powell said that, yes, we are in restrictive territory. Is that how you'd characterize it as well?
I certainly would. If you think about interest rates where they currently are versus their long-run average, that gap is still relatively large. Now, one thing that came up in the press conference I think is very important to pay attention to, which is that the impact of a central bank on an economy is really the translation of its policy through banks and markets. And there, a big difference between Canada and the United States is that a lot of our household financing and corporation financing comes through markets. And measures of financial conditions have gotten very, very easy on this side of the border, which has actually done some easing for the Fed or in spite of the Fed. That's one of the things the Fed is going to have to monitor very, very closely. Garrett, the rally that we're seeing in equities is only going to make those financing conditions easier and might tend to contribute to a Fed that stays on hold for maybe a little bit longer than we thought.
Though Powell said he doesn't see the direct link between easing financial conditions and inflation, which perhaps maybe is up for debate. Garrett, now that there were no real hawkish surprises and we know that we have to just track the data, maybe it's off the table for 2024. There's been this adjustment in equities, right? This downdraft in April. Do you view it as just that, kind of a digestion of how far we've come and that more gains are ahead? Is that possible in an environment where we are higher for longer?
Yeah, I mean, ultimately, I think it comes back down to the data. So I would echo a lot of Carl's comments. You know, I push back a little bit in terms of financial conditions. Yes, I think in the market sense, markets and equities going up and rates potentially coming lower eases financial conditions. But in terms of the way the Fed thinks about it, it's a little bit more broad. And so what Carl is mentioning in terms of financing starting to eventually bite a little bit more and more, I think is a big reason and a greater way to think about how the Fed thinks about financial conditions. But at the end of the day, I think the data suggests that the blip so far this year in terms of inflation is a little bit more of a head fake. And when you look underneath the surface, you know, if it was really about demand picking up, growth being strong, financial conditions maybe easing from the end of last year, wouldn't you expect to see a lot of that pickup in inflation being driven by cyclical components? And it's actually been the exact opposite if you kind of break down PCE into cyclical and acyclical. It suggests it's a little bit more idiosyncratic and industry specific in nature. And so to me, I think it suggests that a lot of that pipeline of disinflation that we know is in store, especially in shelter, likely to start coming through in some of the problem children in motor vehicle insurance and elsewhere. I think that starts to bite as you move into the summer months. And so from the starting point now, we're actually still holding up fairly well given the hawkish repricing in markets. I think it sets you up for potentially resuming that uptrend for broader equities. And ultimately, that's a byproduct of data coming in below expectations. And I think that's the greater risk moving forward, is that markets have gotten too hawkish, and that sets up the potential for some downside surprises as we see some of those disinflationary dynamics start to play back out through the data over the next couple of months. And
a lot of what we're talking about, Carl, and I want to give you this final point, is very U.S. specific. And you mentioned Canada. You know, our growth trajectory is weaker according to the latest GDP readings. We are expecting, it's at least more fully priced in for this summer, that we could get the first rate cut. Other economies are experiencing slower economic growth. How much of a divergence do you expect there to be between U.S., central bank policy, maybe Canadian, but other central banks out there? And is there a limit to, how much some of these economies can diverge because of how that might show up in the currency, for example?
Excellent question. The U.S. outperformance is due in part to unexpectedly persistent strength in households, but U.S. government spending is probably the bigger differentiator between our performance and other countries. Whereas all countries stimulated during the pandemic, the United States just kept right on going with major packages. Our fiscal deficit this year is going to be about 5.5% of our GDP, much larger than you see elsewhere. That's goosing the economy in the short term, could be costly in the long term, but for now, it's one of the reasons why capital is still flowing in this direction, and a reason that the dollar is stronger. This is having an international impact as other central banks sensitive to their exchange rates are really struggling with those persistent interest rate differentials. As you all know, Japan had to intervene to keep the yen from getting weaker, even weaker earlier this week. And other central banks around the world who already have settled inflation would love to cut, but they can't until the Fed makes the first move.